love the channel and find it useful in becoming a happy retiree. Subscribe today. We're talking decentralization of consumerism and how that's spun to a point where big consumer staple type companies have gotten hit very, very hard. And the question is, where do we go from here? We're going to come back to that. I also want to get to what a lot of these bigger companies have been doing with repatriated money. Apple, Cisco, Gilead, Pfizer, Johnson & Johnson, Honeywell, Coke, Ben, which is Ben Franklin, or Franklin Resources, which is a big mutual fund company, Sempra Energy, United Technologies, Rockwell Automation, who, by the way, United Technologies is buying Rockwell or proposing to buy Rockwell, Eli Lilly. What are they doing with the hundreds of billions of dollars that's coming back to the United States, repatriated overseas cash? It's coming back here to the United States. What are they doing with all that money? A couple of thoughts here. I want to wrap up this discussion about, well, yes, let's go to consumerism. Well, I want to wrap that up, and then I'll talk about this cash repatriation, what this money is doing coming back into the United States, the hundreds of billions of dollars coming back to the United States. Now, I'm back to decentralization of retail. And you've got a lot of frustrated investors with consumer staple names that are down 15, 20%. Procter & Gamble is one of the examples I gave. Walmart's another example. Coca-Cola is another example. And I'm telling you this story about how my buying, and this is, I think, a microcosm of America. What do? We used to go if you think back 100 years, we were very decentralized. We went to the butcher and the baker, and we went to all these individual stores. And then at some point, they became centralized. And we had the mall movement in America. We had the grocery store in America, then the super center in America, and everything got centralized. And now with the Amazon effect, A, Amazon is a company, B, the propensity and the ease of use of internet shopping has decentralized a lot of retail. So instead of just going and getting T-shirts at a big one store, after a while I got frustrated that there was no inventory. They never had my size. I started going online to specialty retailers that effectively same amount of money, but just did one product line like undershirts. And they just did a better job, and they always had my size. And then the next thing I knew, I started using these specialty retailers for a lot of different things. And that's the cloud that has hung over the Walmarts of the world and the Targets of the world. And quite frankly, the Procter & Gambles of the world, is that what if all these smaller companies, and I mentioned a sock company that I use called Bombas, and Bonobos that kind of competed against head-to-head of J.Crew, and Mack Weldon, which competes directly with, let's say, Fruit of the Loom. What kind of chunk do they take out of these larger staple-type companies? Well, here's what has already started to happen. So again, we've gone from one big store, and that's been replaced by 5 or 6 tiny stores. What's going to happen? Well, first of all, the Dollar Shave Clubs of the world, and the Bombas of the world. All these little but really, really good retailers, they've either already been swallowed up by these giant retailers, or they're going to eventually get swallowed up. That's kind of what's happening here. So Bonobos, they did affordable, let's call it men's affordable yuppie clothing. That just sold to Walmart. Walmart said, wait a minute, they're doing something smart. We like their clothes. Walmart just said, here's $310 million. Now you're part of us, right? This is a company that's not that old. What are the founders going to do? Say no to that? Think they're going to say no to that? I think they're going to cash out. And that's exactly what they did. That's a drop in the bucket for Walmart, yet they get this powerful brand. And that happened back in 2017. Nordstrom swallowed up a company called Trunk Club in 2014, over $300 million. Now, by the way, the Trunk Club piece now is only worth about half that, but that's a whole other story. Dollar Shave Club, right? This is the really funny commercial, the guy that makes $1 razors. He's kind of walking through his warehouse. The commercial went viral. Company blew up. Well, guess what happened? They sold to Unilever for a reported $1 billion. Still, now that is a lot of money, even for Unilever. But now that powerful little retail brand that is Dollar Shave Club that was taking a chunk out of their shaving business, well, now they're part of that big conglomerate. They're part of the deal. So the Procter & Gamble's of the world are not going away. The Unilevers of the world, they're not going away. They're not going to get eaten up by these smaller, faster growing, decentralized group of companies. The smaller companies are going to get swallowed up by the giants and eventually start feeding their bottom line. So now, despite Procter & Gamble, even though the stock price has suffered, down 20%, still a very profitable company. Now, Procter & Gamble, it's trading well below its long-term average of 18 times in earnings, and it yields now almost a 4% dividend yield. Since 1980, Procter & Gamble, most of the time, because the price has come down, has yielded above 3.5%, about 20% of the time. When the dividend gets to that point, and again, usually because the stock has dropped, the next 12 months have been positive 96% of the time, with an average rate of return over the next 12 months is 28%. Kind of an interesting story here to take a look at. Again, this is a broader audience. This is Money Matters. I'm not pounding the table and saying you got to go buy this stock. I'm just giving you an example of what happens to a big staple type company when they run into a little bit of trouble. What happens over the next 12 months when you've got a yield like this? Well, these are just the numbers. So I can't recommend any particular companies, of course, here on Money Matters, but take a look at this. 12-month returns after this have been at the point they are at today, with a dividend yield that's just almost 4%, 3.9% today for the dividend yield. 96% of the time has been positive over the next 12 months. Hey, listen, this time might be different. I don't know, but I doubt it. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.